Okay, before we get into this, let me preface it by saying this is one of the lessons that if you just look through it quickly and not paying much attention to it, it's going to look rather ambiguous. It's going to seem unfruitful, but its impact is shown and solidified really by you going through the price data and seeing these profiles unfold in hindsight, seeing how they operate and the conditions that I'm giving you, how they are always generally precursors to them forming. So the classic Tuesday low of the week. Okay, this is a market profile that is generally bullish. So you're already looking for bullish prices anyway. And what you're looking for is manipulation in the form of price hovering above a higher time frame discount array on Monday, then drops into a higher time frame discount array on Tuesday to form the low of the week. How to anticipate this, you have to know the higher time frame discount arrays and when the market fails to drop into that array. Odds are Tuesday will likely see the drive lower Tuesday London Open and or New York session. For the classic Tuesday low of the week, what you'll be looking for is a market that is primarily bullish and the market trades down on Tuesday into a discount. Now this is going to be in the form of either an old monthly, weekly, or daily low to run a liquidity pool. In other words, it's running out sell stops. Thursday and or going into Friday, but generally you want to look for the high to form for the week by Thursday's New York session. It can carry over into Friday a little bit, but in the general rule of thumb, just look for Thursday as the lion's portion of the weekly range, and you're looking for it to trade up into a premium market PD array. Now the key is you're going to be looking for a time frame lesser than the discount liquidity pool that you use to buy off of. For an example, if you bought a monthly liquidity pool, you're going to be looking for a weekly or daily premium PD array to trade up into. Another scenario for the discount market, you see the market trade down to an old monthly, weekly, or daily high. That means the market has already broken out above a historical high or an old high, and the market has now come back and retested that area as support. You'll be looking for this market to trade up into a premium PD array and or a fib extension combination of 127 or 168 extensions, or a 100% symmetrical price swing, or what I classify as a perfect market structure swing. You're going to be looking for it to trade up to this premium market PD array and overlapping fib in a time frame lesser than the discount old high. So in other words, if you're trading at a weekly high as support in the form of a discount market, you're buying down there as a support idea. If it's the weekly high that you bought, you're going to be looking for a daily or 4-hour PD array and an extension of either 127 or 168, or preferably a perfect symmetrical price swing of 100%. Another scenario for the classic Tuesday low of the week, we'd be looking for the market to trade down into a discount market and trading into a bullish order block. This could be either a monthly, a weekly, and or daily, or any combination of an overlap of those three time frames. It can also be a 4-hour, and or this can occur as a market is already been trading higher and you've determined the overall price move may be much significantly higher than what you see graphically depicted here in this diagram. In other words, it could be a multi-week scenario where the market could trade higher for more than 1 week. So if that's the case, you could be seeing the trade down into support or bullish order block on Tuesday, where you'll see the first swing grade, or it could be happening at the equilibrium price point, where price could be expanding up and seeing an equal measured move higher, or it could be a third swing grade. Now, generally, third swing grades are the halfway point between the equilibrium and the ultimate objective in your price objective for the trade. Generally, you don't see a stop run in the third swing grade right before the terminus of the price move you're looking to trade entirely as the profit. Go back to the lessons where we talked about grading the swings, and you'll see what I'm referring to. That third area, or midpoint between equilibrium and your target, generally you don't see a stop run there, but you do get a bullish order block sometimes that you can trade off of. This is that type of scenario we can use this template. Regardless of what time frame you use, you're going to be looking for it to trade up into a premium market PD array and or fib extension overlapping of 127 or 168, or a perfect symmetrical price swing, or basically 100% duplication or measured move of the price swing that traded down into the Tuesday low. And you'll be looking for it to trade up into a time frame lesser than that of what you used for the bullish order block. So again, if we used a weekly order block, we're going to be looking for a daily or 4-hour premium PD array to take our profits at. something lining up with price above us in the premium market, but in a time frame lesser than that which we traded our entry on. Fair value or a liquidity void also could be an instance where this trade could materialize. Okay, the next one is the classic Tuesday high of the week. This market profile is generally bearish. You're already expecting lower prices. And the manipulation you're expecting is when price is hovering below a higher time frame premium array Monday, then rises into a higher time frame premium array on Tuesday to form the high of the week. And you anticipate this forming by knowing the higher time frame premium arrays, and when the market fails to rise into that array, odds are Tuesday will likely see the drive higher, Tuesday's London Open and or New York session. Just like the classic Tuesday low of the week, well, the classic high of the week, there can be another run higher to make a higher high in the week for this profile than the high that was formed in the London session Tuesday. So in other words, it can come back and run the London high out and still form this. For the classic Tuesday low of the week, it can come back and make a lower low in the New York sessions. There's one caveat that has to be applied to both of them, so have that in your notes. Okay, the first scenario we're going to look at is a market trading up into a premium market. It could be trading up to an old monthly, weekly, or daily high in the form of running a liquidity pool. In other words, buy stops above an old high. And we'll be looking to frame the trade with a time frame lesser than that which we used for the premium liquidity pool. And we're going to be trading down into a discount market PD array. What you'll be framing is, for instance, an example would be if you sold short at a daily high being ran out for a liquidity run on buy stops, you could see a 4-hour discount PD array to trade down into as your objective. Another example would be if you're looking for a weekly high to run out buy stops, you'd be looking for a daily or 4-hour discount market PD array. Again, you're looking for a time frame lesser than that which you use to trade with. Since we're using monthly, weekly, and daily as a framework, it gives us a great deal of probability that the moves are going to take place. Secondly, we're using a lesser time frame to take our targets, because we don't want to hold for what would many times take greater than a week to unfold for a move, moving off of a monthly or weekly level. Okay, our second scenario for the classic Tuesday high of the week would be the market trading up into a premium market and trading up to an old monthly, weekly, or daily low. That means the market's already broken down out of a measure of market structure, or maybe it took out an old low. Now it's retesting that as support broken, now resistance. And we'd be looking for a discount market PD array and or fib extension of 127 and 168 and or a perfect symmetrical price swing and a time frame lesser than that which we used for the premium old low. So in other words, for an example, we would be looking for the market in a bearish context. We're looking for lower prices overall. The market opens on Monday, trades up into Tuesday, creating the high of the week, but it's retesting a old monthly, weekly, or daily low. So that daily low, whatever it is, we're going to be using that as our means of framing our entry, with the expectation that we're going to be selling short, looking for a discount market PD array in a time frame lesser than that which we used to get short off of. So if we're trading a weekly low as resistance, we could also employ a lower time frame bearish order block or something to that effect to get in sync with it. But for instance, if we're using the weekly low, we'd be looking to trade down to a discount daily or discount 4-hour market PD array and an overlapping fib extension converging at the 127 or 168 or a perfect symmetrical price swing. Many times you'll see that the fair value or void that fills in is all that's necessary before the Tuesday highs form back up to that old monthly, weekly, or daily low. Okay, our next scenario would be, again, a fair value or liquidity void and a market moving up into a premium. Bearish order block, either a monthly, weekly, or daily, and or it could be a first swing grade or at equilibrium, or it could be a third swing grade entry. In other words, if we're seeing a larger, longer term price move going lower, if we graded our swings, we could be looking for this scenario to take place at the first grade swing, equilibrium, or the third swing grade. Discount market PD array or fib extension, 127, 168, or perfect symmetrical price swing, measured move, in a time frame lesser than the bearish order block we use to trade off of. Now, I'll give you an example on this one. The market makers will see for instance, we could gap open lower on Sunday. And then all through Monday, we could trade up through higher, and then up into Tuesday, London Open or New York Open, we could create the high of the week. We would be in a premium market relative to the weekly range that's just started. We would potentially fill in a fair value gap or a liquidity void, trading back up to, for instance, a daily bearish order block. So if it gets to a daily bearish order block, we could be using a 4-hour discount market PD array that overlaps with a 127 or 168 or perfect symmetrical price swing in our fib. And you hold for that opportunity to unfold until Thursday and maybe into Friday. Okay, the next one is the Wednesday low of week. This is when you're generally bullish on the marketplace already. And the manipulation you're looking for is when price is hovering above a higher time frame discount array Monday and Tuesday, then drops into the higher time frame discount array on Wednesday to form the low of the week. You anticipate this by knowing the higher time frame discount arrays, and when the market fails to drop into that array, odds are Wednesday will likely see the drive lower Wednesday's London Open and or New York session. Monday and Tuesday can also be down days as well to form this profile. Wednesday London session low can be ran out on the Wednesday New York session, and then it can create the low of the week. So be aware that that can possibly happen as well. Okay, we'll generally see the market show a short-term low on Monday and trading up into Tuesday. And then Tuesday, we'll see it trade lower down into a discount market. Now, it could be trading down into an old monthly, weekly, or daily low for a liquidity pool. In other words, running out sell stops. And we're looking for the market to trade up into a premium market PD array in a time frame lesser than the discount liquidity pool that we used to trade off of for a long. You'll see this if you're familiar with my old teachings. Many times this is the framework I use for a reflection pattern. The reflection pattern is basically a 127 or 168 extension where it runs at an old low, but it's going to trade down to a discount market PD array. If it takes out the sell stops below the lows, we're going to be looking for the market to trade up into Thursday or Friday, preferably Friday, into a premium market PD array. If we're going to see this occur on a weekly, we're going to be looking for the long on a weekly and exiting our position on a daily or 4-hour premium market PD array. Okay, our next example for the Wednesday low of the week, we can frame our market with a discount market old monthly, weekly, or daily high. In other words, we've seen the market trade up, broken out, now it's coming back down. Monday, we started to trade up a little bit, then Tuesday, it traded lower down to the old high. So it could be a monthly high that it retrades back down into on Wednesday, and we're going to be framing that with an expectation of seeing the market rally up into Friday with a premium market PD array and or fib extension of 127, 168, or perfect symmetrical price swing in a time frame lesser than that of which we used for the old high long. So for instance, if we bought a old monthly high retest after it's broken out, we can see the monthly high acting as support. So our lesser time frame PD array for a premium target would be seen either in a weekly, daily, or 4-hour. The key is finding where it overlaps with the 127 and 168. We're not just simply looking for 127 and 168 extensions. We're doing that also and coupling it with, in all these examples, with a lesser time frame PD array that's contrary to what we use to enter the trade. Okay, our third example for the Wednesday low of the week, we could see the market trade down on Wednesday into a discount market when the market's generally primarily bullish anyway, and we're going to trade into a bullish order block, and it could be in the form of a monthly or weekly or daily, or it could be a first swing grade entry. In other words, if we see the market moving higher, much longer term than just 1 week, and we're seeing our first retracement back where we can get our long on, a swing trade or a position trade on that, it could occur at that first swing grade, or it could occur at the equilibrium of the overall price move or halfway point of what you expect to see as an overall price target, or it could occur at the third swing grade. In other words, 1/2 between where your halfway point or equilibrium is for the trade and the ultimate target. Remember, when we look at price swings or targets in trades, we graduate it into 4 stages. First stage, second stage takes us to equilibrium, third stage or third swing grade, and then the fourth is terminus, where the end of the trade takes effect, and that's where your profits are taken. That's the maximum we expect to see the market move. This occurs sometimes at the first equilibrium and third swing grade as a potential opportunity. So the market could be just floating around between a premium and discount market on Sunday and Monday and Tuesday. But then Wednesday it trades down into a discount level where it clearly hits a order block, and now it can be capitalized and send price higher up in through Thursday into Friday. The fair value or liquidity void, that run down, that price swing is what you use your fibs on to run your extensions for 127, 168, or a perfect 100% duplication of that price swing down, just projected from the high. The next one is the Wednesday high of week. This profile is generally bearish. You're already looking for lower prices. And the manipulation you're expecting is when price is hovering below a higher time frame premium array Monday and Tuesday, then rises into that higher time frame premium array on Wednesday to form the high of the week. You anticipate this by knowing the higher time frame premium arrays, and when the market fails to rise into that array, odds are Wednesday will likely see the drive higher, Wednesday's London Open and or New York session. Monday and Tuesday can be up days as well to form this profile. Just like we mentioned for Wednesday low of week, the London Open high on Wednesday can be ran out on Wednesday's New York session and still create the high of the week. So have that in your notes.
Okay, Wednesday high of the week. This is when you're looking for a bearish market environment. Okay, and you have a short-term high here. The market will trade up into a premium market, up into an old monthly, weekly, or daily high liquidity pool. In other words, it's running out an old high. And we're framing the idea with a move down into a discount market, PD array, in a time frame lesser than that which we used for a premium liquidity pool. For instance, if we are expecting bearish prices, and this can occur in an equilibrium area on a larger price move that you expect maybe from a position trader's mindset or a swing trader's mindset. In other words, if you're looking for a move that's much longer than just 1 week, we could be the midway point of that, and you'll see a short-term high being ran out. This is a classic stop run, and this is generally what you see on a Wednesday. And if you see it on, for instance, like a weekly liquidity pool, if it runs out a weekly high, it takes out those buy stops, we could expect to see a daily or 4-hour discount PD array be our objective for the week. Okay, another example for Wednesday high of the week. Okay, we have a fair value or liquidity void, and then it runs through that for the stops. If we see that and we're overall bearish, this again, we're going to be looking for this as a scenario where it's a retest to an old low. Okay, this could be a return back to a premium market in the form of an old monthly, weekly, or daily low. And we're looking for a discount market PD array and or a fib extension of 127 to 168 and or a perfect symmetrical price swing in a time frame lesser than that which we used for a premium old low retest. So in other words, if we're looking for a retest back to a monthly low, if we get short on that monthly low, when we use the hourly chart, we can fine tune that to a smaller degree of risk, but we're framing our trade off of the monthly low that's being retested, traded button to Wednesday. We're going to be looking for that opportunity to send us lower. If it's monthly that we're looking at that low on Wednesday that sells short from, we're going to be looking for a weekly, daily, or 4-hour discount PD array that has an extension overlap of 127 to 168 or perfect symmetrical price swing from that low up to Wednesday's high. In other words, Tuesday's low to Wednesday's high, that price swing up, that's what you're going to be anchoring your fib on, and the extensions below Tuesday's low would be a projection of 127, 168, or a perfect symmetrical price swing, or that of Tuesday's low to Wednesday's high, that range subtracted from Tuesday's low. That would be a perfect symmetrical price swing. If you get that overlapping with in this case, if we were looking at a monthly low, we could be looking for a weekly, daily, or 4-hour discount PD array that overlaps with that. So again, we're blending time and price. In the last example for Wednesday high of the week, we're looking for a fair value or liquidity void, price trading up into a premium, into a bearish order block on a monthly, weekly, or daily basis, or it could be returned back into our first retracement of an overall larger price swing, and this will be the first swing grade entry, or it could occur at equilibrium, or it could be a third swing grade entry. Discount market PD array or fib extension, preferably both overlapping in 127 or 168, or perfect symmetrical price swing in a time frame lesser than that of the bearish order block that we use to trade an entry on.
Okay, the next one we have is consolidation Thursday reversal. This is a generally bullish market condition. So what you're looking for in manipulation is we're going to be looking for consolidation Monday through Wednesday. Then price runs the intra-week low and rejects it, forming a market reversal. The key is it's consolidating. It's not really going higher or lower Monday through Wednesday. How to anticipate this is you have to know the higher time frame discount arrays, and when the market fails to drop into that array, odds are Thursday will likely see the drive lower Thursday on a market driver, news and or rate release late New York session. And this is typically around the 2 o'clock Eastern Standard Time or 2 p.m. New York time.
You'll see this happen where the market opens up on a Sunday and Monday, trades sideways on Monday and Tuesday into Wednesday, and then all of a sudden the market trades down on Thursday into a discount market. You're going to be looking for, many times, traders expecting the market to shoot higher because of buy stops being taken out or will be deemed as a market structure shift bullishly. But we're looking for sell stops in a bullish market to be ran out. So when that happens, generally it's going to be like a FOMC or an employment release. The FOMC release generally happens around the 2 o'clock hour in Eastern Standard Time, New York time, or it could be a New York session employment data release that can send the market higher based on this false break below an old low earlier in the week on Monday or Tuesday. This false break becomes a turtle soup long, and you're looking for the market to trade up into where the weekly buy stops are. This is your liquidity pool, and it's going to trade up into that level as your weekly objective. So your one shot, one kill setup would be buying the break below the weekly low on Monday or Tuesday, running out the sell stops on the heels of either a high impact news event with employment data on the New York session around 8:30 in the morning Eastern Standard Time, or if you just want to play the FOMC announcement, once the market drives down, takes those sell stops out, you can take a very, 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 very low risk entry and small position. Don't put a lot of money on this type of trade because if it's FOMC, you can get really crushed if it's a lot of whipsaw on it. But if you're going to be trading FOMC, very, very small position, wait for the initial knee-jerk reaction, put your limit order down below the low that's formed on Monday and Tuesday, absorb all those sell stops, and look for the buy stops to be ran out for the intraday high or running out the intra-week high in the form of the buy stops liquidity pool. So your one shot, one kill would be framed on a Thursday going into Friday. So it's really 1 day's worth of action that you waited for all week, but the scenario looks like this generally.
Okay, consolidation Thursday reversal for a bearish market profile. The manipulation you're looking for is consolidation Monday through Wednesday. Then it runs the intra-week high and rejects it, forming a market reversal. You anticipate this by knowing the higher time frame premium arrays, and when the market fails to rise into that array, odds are Thursday will likely see a drive higher, Thursday on a market driver, news, or rate release late New York session around 2 p.m. New York time. Now, just like we saw for the bullish consolidation Thursday reversal, this is generally on rate announcements, FOMC or interest rate adjustments.
On Thursday, the market trades up into a premium market. Earlier in the week, it'll look like it's taken out sell stops or a market structure shift has broken to the downside. And then Wednesday into Thursday, you'll see the buy stops taken that were formed intra-week. Usually FOMC, 2 p.m. Eastern Standard Time, or a 8:30 a.m. Eastern Standard Time employment release could be the driver for this, where the market's driven up to above the intra-week high to take out the buy stops in an overall bearish market environment, and the market causes a false break. This is a turtle soup short, and you're going to be looking for the targeting of the sell stops below the intra-week low for your liquidity pool.
Okay, consolidation midweek rally. This is a bullish market profile. Already expecting higher prices when you're looking for this. The manipulation you're expecting is consolidation Monday through Wednesday, then runs the intra-week high, and then expands higher into Friday. How to anticipate? When the market is bullish and has yet to run to the premium array on the higher time frames, it has recently rallied from a discount array and simply paused without any bearish reversal price action, indicating price is about to expand higher for the premium array.
What we generally look for is the market to start off on a Monday, right from the beginning, and on Tuesday, it'll see a retracement down into Wednesday, and you're going to be moving back into a discount, fair value gap, or liquidity void, or bullish order block. So any one of those scenarios could be your catalyst, but you're looking for a discount PD array, and you're expecting on Wednesday a high or medium impact news event, either in London or in New York session. Your swing projection or fulcrum point is the intra-week high formed on Tuesday. Now, this could also be a Monday high, too. In other words, it could trade up to creating a short-term high on Monday and then trading down Tuesday and into Wednesday. But that's one simple caveat to this template, and it's reversed for when you're looking for a consolidation midweek decline. But you're aiming for a premium PD array, either in the form of a monthly, weekly, or daily, and converging fib extensions of 127 and or 168. Or it could be a perfect measured swing projection. Now, what does that mean? The swing projection fulcrum is the highest high at which the market starts to retrace from. That's the point at which you want to pull your fib down from into where it trades into the order block. That'll give you your swing projections up into the premium PD arrays. Let's take a look at that, what that looks like in an example. So we have our high here. This is going to be our swing point fulcrum. And then we're going to take our fib, anchor from the high down into the order block or whatever PD array that we're using for a discount to enter. That's our level we expect price to move up from. So there's our range. What we get then is an extension of 127 and or 168 fib extension, which takes us up into the premium market. What we look for, not just a fib of 127 or 168, we're looking for a time frame lesser than that which we used to get long on either a bullish order block, bearish order block, whatever that time frame we see forming our entry on Wednesday. We use a lesser time frame to take our profits at. But it has to be an overlapping of a premium PD array and a lesser time frame we use to buy at that overlaps with 127 and 168. Now, the fib overlap levels are based on the time frame we enter on. We look for a lower time frame to see a PD array in the premium range to overlap with that 127 and 168. When we get those two things, we have a high confluence level where we have both time and price in agreeing, where the algo may very easily retrace for those levels, and then that'd be it for the target.
Consolidation midweek decline. This is a bearish market profile. You're already expecting bearish prices, and the manipulation you're looking for is when price is consolidating Monday through Wednesday, then runs to intra-week low and expands lower into Friday. You anticipate this profile forming when the market is bearish and has yet to run the discount array on the higher time frames, and it has recently declined from a premium array and simply paused without any bullish reversal price action, indicating price is about to expand lower for the discount array.
Okay, what we're seeing is on Wednesday, you'll see it could occur on Tuesday too, but we're looking for a premium fair value gap or liquidity void to be filled in, or trading up into a bearish order block, and high or medium impact news in Wednesday London Open or New York Open. And we have a swing projection fulcrum point. And we expect to see the market trade down to a discount PD array in the form of a monthly, weekly, daily, and converging fib extensions in the form of 127 or 168. And again, it could be a perfect symmetrical price swing or 100% measured move. So let's take a look at what that looks like as well in reverse terms of what we just showed for the buy side. Okay, we have our premium fair value gap or liquidity void and or bearish order block. In other words, we're looking to sell short at a premium PD array in a bearish market environment. We know our low of the week is formed, measure that up from our fulcrum point, and we get our 127 extension from that low to Wednesday's high. Projected down, that's 127% of the range between Tuesday's low and Wednesday's high. And then we get the 168% of the range of Tuesday's low to Wednesday's high. Now, you don't need a Fibonacci overlay tool for this. All you have to do is get Wednesday's highest high and Tuesday's lowest low, or it could be Wednesday's low. Okay, but basically you're looking for the lowest low between Monday's opening and Wednesday. When it trades up, it's got to be trading up. So whatever that highest high is that forms, your projected low is whatever the range low is for the week up to Wednesday's high. That range in terms of pips, times that by 1.27, and that'll give you your range that you subtract from Wednesday's high. And you can do the same thing for the range from the low of the week up to Wednesday's high. Whatever that is in terms of pips, you times that by 1.68, and you subtract that number of pips from Wednesday's high, and that'll give you your Fibonacci extension low.
Seek and destroy bullish Friday. This is a neutral or low probability market profile. The telltale signs the manipulation is taking part in this profile is where price is consolidating Monday through Thursday, running shallow stops under and above the intra-week highs and lows, then runs the intra-week high and expands higher into Friday. How to anticipate it? When the market is awaiting interest rate announcements and or non-farm payroll can create this profile in the summer months of July and August. It's better to avoid trading these conditions altogether.
All we're really doing is watching to see if it gives us any favorable outcome. And it's more or less a market environment you want to be either on the sidelines or just demo trading just for experience. Okay, the market will generally create a small consolidation throughout the week going into Thursday. We have a liquidity pool for sell stops that forms in intra-week. Higher medium impact news on Thursday. Usually it's tight, like I said, it's either a FOMC or employment decision, and we're going to be anticipating the sell stop raid below the lows of the week. Intra-week buy stops would be determined, and a liquidity run to a daily or weekly premium PD array would be the result. In other words, we're not going to be looking just for a intra-week run on buy stops. We're going to be looking for a run completely above all of the intra-week highs to a liquidity run on daily or weekly premium PD arrays. So in other words, we're going to be creating a new weekly range high in a level that hadn't been traded for so far for that week, and it's going to move it aggressively and very speedily to that level. Now, this market environment can occur when the market's bullish, but it also can occur when the market's bearish. If the market trades down below an old low or breaks out on a higher time frame, but fails to have any movement lower, we can get a Thursday high impact or medium impact news event or interest rate environment that sends us aggressively higher in this environment or this market profile. This is one of the hardest ones to trade, and if you see the market just consolidating back and forth, taking buy stops and sell stops, throughout the week, it's probably better for you to just sit on your hands and just don't trade anymore, because the chances are you getting this right are not 50-50. And if you're wrong, it can really blow through whatever your stop loss is, especially if it's FOMC or if it's, well, it would just have to be something along with the monetary policy. Once it gets up to a daily or weekly premium PD array, what we're looking for there is we want to see possibly a potential reversal. So what we're doing is why is this template useful? There's your answer. You're waiting for it to get up to a daily or weekly premium PD array. Once it does that, we are expecting a reversal.
Seek and destroy bearish Friday. The profile again is neutral, low probability. Manipulation is seen by price consolidating Monday through Thursday, running shallow stops under and above the intra-week highs and lows, then runs the intra-week low, expands lower into Friday. How to anticipate it? When the market is awaiting interest rate announcements or non-farm payroll can create this profile in the summer months of July and August. It's better, again, to avoid these conditions.
What we're looking for is the outcome of this. We're not looking to trade it. So we're looking for the market to create a consolidation Monday through Wednesday and then building a liquidity pool of buy stops intra-week. And on Thursday, we anticipate that market to be taken up to that level, taken out to buy stops, and a run on high and or medium impact news usually is the catalyst for that. We're anticipating the buy stop raid, and the market will run the intra-week sell stops and ultimately target a liquidity run to a daily and or weekly discount PD array. Again, we're not looking to trade this. We're looking for it to unfold. Usually when the markets are in consolidation Monday, Tuesday, and Wednesday, and it's usually like a employment number or it's a FOMC type event, that type of market driver that's released later on in the week, the second half of the week, post Wednesday New York Open. We're looking for the market to run to a higher time frame PD array, okay? And if we see they run the buy stops intra-week and they sink it lower, what we're going to be watching for, not that we're trying to trade it, we're looking for it to trade down into a higher time frame, daily or weekly, discount PD array. When that happens, what we're looking for is a potential reversal.
Wednesday weekly reversal. This market profile is bullish. You're already expecting higher prices. The manipulation you're looking for is where price is consolidating Monday through Tuesday and drives lower into a higher time frame discount array to induce sell stops, then strongly reverses. How to anticipate this? When the market is trading at a long-term or intermediate-term low, price will pair institutional buying with pending sell-side liquidity, or traditionally known as a sell stop raid.
Okay, Wednesday weekly reversal. Now this is not the same as the Wednesday low of the week. This is a little bit slightly different. We're looking for an old low or retail support, and high or medium impact news drives price down below that, and it is generally on a higher time frame basis that we see these types of moves taking place. In other words, we're running a weekly, monthly level or support level out, and it's on the heels of higher medium impact news, and then once it dries down below that, the market discounts that news and reverses. What we're looking for is a Fibonacci extension of 127 or 168, or even a perfect symmetrical price swing, but generally it's usually a 127 or 168 extension from the old low retail support, rally up into Tuesday's high, project that down. That'll give us some measure of extension. The market usually will find its way down into a monthly, weekly, or daily discount array, and we'll be using the swing projection fulcrum point to project up to a 127 or 168 extension and overlapping of a weekly or daily premium PD array.
Wednesday weekly reversal, profile bearish. You're already expecting lower prices. The manipulation you're expecting is when price is consolidating Monday through Tuesday and it drives higher into a higher time frame premium array to induce buy stops, then strongly reverses. How to anticipate this? When the market is trading at a long-term or intermediate-term high, price will pair institutional selling with pending buy-side liquidity, or as otherwise known, a buy stop raid.
Okay, we're looking for old high or retail resistance. Higher medium impact news runs it above it, and then the market rejects or discounts that news event and it takes us up into a Fibonacci 127 or 168 extension and a monthly, weekly, or daily premium array. In other words, we're looking for something up there to align with that 127 and 168 extension. And then the market will look to move below the swing projection fulcrum point down into a weekly or daily discount PD array, overlapping with a Fibonacci extension of 127 or 168. The weekly range, you'll find it generally will be one of these templates. So if we're looking for information to lead to bullish or bearish ideas, if we have that limited to, okay, we want to be bullish, we go to our profiles that are bullish. And we start looking for telltale signs or characteristics that are given to you in these slides. By blending that and also looking for the manipulation factor that takes place, how the market makers manipulate price within these market profiles, you're going to see that it's pretty much almost like to script. Now, the key is once you identify it, the moves that transpire on Tuesday and Wednesday, you may not get the actual highest high to short from or the lowest low to buy from, and that's not important. Once we have the range defined and we see the characteristics that outline a potential direction going into Friday's close, that in itself can be your one shot, one kill. So you can look for opportunities on the back end of the week, not necessarily demanding an entry on Tuesday or Wednesday, because I teach Tuesday and Wednesday generally will give you the higher low of the week if it's a bullish or bearish respective market. That's not necessary. One shot, one kill is you're looking for one setup to pay you your weekly objective. My objective is usually 50 to 75 pips a week. So if I'm looking for something that's going to frame that type of move, I'm generally going to be using these manipulation templates to frame the idea, whether I'm bullish or bearish, and I'm looking for characteristics to line up. If those characteristics aren't obvious or in alignment, then I'm generally going to sit on my hands and either day trade, scalp, or do nothing.